Hello, Propenomix people, and welcome also to people tuning in on the Property and Poppadoms Facebook group live. So this is the weekly Sunday supplement live. This one was called Lowering the Speed Limit to Save the Economy and Other Bureaucratic Delusions. Because that's exactly what it is, realistically, isn't it? If that's the best you can do because you're such a weak nation who has to take the price of energy after 50 years of underinvestment and terrible energy strategy and basically making every mistake that you really could on that front. It's just a bit of a joke, isn't it? So the title of this week's was a bit of a joke. But if you haven't listened to one of these before, I like to start with a quote. And this week's was: the era of procrastination, of half measures, of soothing and baffling expedients, of delays is coming to a close. In its place, we are entering a period of consequences. And that was Winston Churchill, who obviously didn't say that the other day, but you understand why that's relevant at the moment. Straight from the big horse's mouth when it comes to quotes. And it seems to be Mr. Trump obviously refers to him on a regular basis, and how similar or not our Prime Minister, Mr. Starmer, is to said Winston Churchill. But perhaps it might be time Mr. Trump actually read some of Winston's wisdom. He might learn something, you never know. But as the calendar advances through our golden quarter, our next property business workshop is live. Tickets are selling well, and this one's about structure and exit, yours and others. Have you got no exit plan? Well, you're going to go out one way or another. Things have changed as well, because pensions are now within the scope of your personal estate. What does this mean for SAS pensions, which are widely pushed within the property arena? Well, you're going to hear that from people who actually use them and don't sell them. So you're going to get an objective viewpoint. Book in on our next property business workshop with me, Adam Lawrence, and Rod Turner. It's Wednesday the 22nd of April in central Manchester, tinyurl.com/PBWTEN. Okay, Trumponomics. Well, Iran's rumbling on, obviously, and oil is up between 48 and 57% on the month when I wrote this. And European gas more like 100% up on the month. Tariffs are, of course, back on the menu. With that Supreme Court ruling, the maximum threat is now 15% rather than the rhetoric of last year. You'll remember in around Liberation Day in China, 100%, 150%. Did we get higher than that? I can't remember. It only lasted for 5 minutes anyway, of course, because as you know, there's a reason why it's called the taco trade. The traders, Trump always chickens out. But there we go. And the 10%'s already been loaded, remember, because that hasn't been thrown out by the Supreme Court ruling as a general rule. Now, look, that's very broad. It's more complex than that, of course, but we're not going to spend a lot of time talking about tariffs. We spent far too much time talking about them over the past 12 plus months, and his favourite word. Well, I'm sick of his favourite word. It's definitely not his favourite word. The cost, it's not our favourite word, the cost to the UK economy for that sits in between 2 and 3 billion if that goes ahead, 10% to 15%. Not huge, you might argue, but not insignificant either. If anyone wants to donate 2 to 3 billion pounds towards the Propenomix cause, of course, I'd be very grateful. This week, the official investigation into 60 major economies, including the UK, looking for forced labour and manufacturing overcapacity, kicked off. What are these? Well, sounds like excuses or reasons for more tariffs or other measures, of course. What are we doing about it? Because we're an energy whipping boy after those 50 years of failed energy strategy or complete lack thereof. Well, like I said, we're considering lowering the speed limit to help conserve fuel. I'm not even sure that even works unless you're solely talking about the motorways, since the last time I checked, the optimal speed of an internal combustion engine was around 56 miles per hour, depending on the vehicle. Most will laugh when they're listening to this if they drive on the M25 on any regular basis, of course. They dream of 56 miles an hour, naturally. But if that's our best plan, it does just show how weak and dependent we are as a nation when it comes to energy, which we knew, of course, anyway. We learned that in 2022, if we hadn't already learned it before. Arguably, we learned it in the 1970s. And on the back of that 2022 situation, though, we announced all of these sorts of forays into nuclear power, didn't we? Except we didn't, did we? We didn't do that. We talked about it a bit. I mean, fantastic. But the trump card, if you'll allow me that amount of poetic license here, for Iran, in terms of the Strait of Hormuz, has now already very much been played. There are alternative routes which they could also close to cause true maximum disruption. We aren't there yet. I listened to some credible podcasts this week while I was doing quite a lot of travelling around the possibility of oil maybe hitting $200 a barrel. The world record is still $147, but that was 2008 money. So actually $200 would be more than it'll still be cheaper than $147 in 2008 money, thanks to the amount of inflation we've had since then, of course. But nobody thinks about it like that. It's all rhetoric, and it's all how much is oil per barrel, nominally it's the important bit, really. And of course, the irony is oil itself going up as much as quickly as it already has done causes more inflation, not less. But anyway, that's where we are, and that's how it gets talked about. The conventional wisdom, which makes sense around the fertilizer situation, because if you, like me, didn't realise Hormuz sees around a third of the world's internationally traded fertilizer go through it in normal times. That's not a third of all the world's fertilizer, it's the internationally traded stuff. So please bear that in mind before you hear anybody ramping that up even to be even worse than it is. Means that we'll hit food prices next year, but there's time to work out alternatives, of course. It doesn't mean this year's food prices don't get hit, because apart from anything else, food needs to get from the producers to the consumers of that food. And how does it do that? Via lorries, logistics, things like that. What do they need? Fuel, as a general rule. But that's where we are. But if you've got a year's notice, you have got time to work these things out, and the longer this goes on, the more working out is obviously being done. But around half of all fertiliser is produced domestically. So as I say, those numbers aren't quite as scary as some of the mainstream media have, for whatever reason, been keen to sort of ramp up. I seem to be doing quite a lot of trust comparison at the moment, and I suspect that's going to go on for some months, years, and maybe decades, to be honest, because I've got a long memory. But this week's appropriate one would be the current estimate for the July price cap moving to around £2,000. Now remember, that's the average household's bills being capped at £2,000, not everybody's bills being capped at £2,000. But when the energy bill bailout came, which you might remember from late 2022, when Jeremy Hunt had been appointed and Kwasi was out, but Truss was technically still Prime Minister, the night watchman budget, or the emergency statement, or whatever you might, the reverse lettuce statement, or whatever you might want to call that work from Jeremy Hunt. Arguably, this was the only positive move that happened under Truss, the energy bailout, apart from the stamp hiatus between 125,000 and 250,000, of course. Obviously, I have no conflict of interest there, except I do. But the cap at that point was £2,500 of 2022 money. So I'm really not clear on why we're talking about universal bailouts at this time. I guess it's just the press, the media, and other people making noise. It seems ridiculous. Now, of course, it does annoy the whole of the general population, but ultimately, I think you've got to really, really dislike Rachel Reeves and Keir Starmer in order to really think that it's their fault what's going on in Iran. The reality is the UK is just a fairly weak global power these days. It's hardly involved or not. It's been dragged in kicking and screaming. It's been slow to get off the block. You can criticise for all of those sorts of things because ultimately Israel and the US were doing this. I mean, you could say that the US are doing it because Israel has dragged them in. Completely depends on your take, doesn't it? But ultimately, we worry about what we can control inside my operation, and I dare say the UK needs to take the same approach here as well. But what could you do? You could target the bottom 10% of households and sort something out by October the 1st, may be reasonable. Heating oil, more difficult because it's tough to get right. Lots of detached properties out in the country have heating oil. Does that suggest they're living in poverty? It seems unlikely. It's been pushed to the local authorities, really, that problem. That makes sense because they understand the demographics and the obligations. Probably a big push for heat pumps, which of course has happened in the last few days where the government have announced new measures around all of that. But I'll cover that in next week's live. So there could be physical shortages. Comparisons to the 1970s, the 3-day week will be rife, of course, if that happens, but not Labour's fault, their supporters will say, and they do have a bit of a point. But my rebuttal, well, everyone who's been in government in the past 50 plus years has to be at fault here, frankly, due to their poor energy policy. So none of this is good, don't get me wrong, but to suggest it looks like 2022 at this time is just false. The bigger problem is that it's getting worse, not better. Just as I said about Ukraine in 2022, when you can't see a way out, these things do have a tendency to rumble on. And sadly, rumble on it has done. But of course, things have been rerouted in the interim. Now, it's more difficult with the geography of Iran and all the rest of it, and what Hormuz does and who it stops from producing, people like Saudi Arabia. Disruptions about 14 million barrels of oil per day on about 100 million global demand. 14% obviously has raised the oil price about 40 to 50 to 60%. As I said earlier, every percent from there on is more problematic. But there we go. I did hear one characterization this week that said, the old regime definitely wasn't great. The new regime, you've got someone who you killed You killed his dad, you killed his wife, you killed his son, you killed all these other people who are important to him. He's unlikely to be a great replacement as far as the US or any of the democratic Western world are concerned, realistically. But that's where we are, right? So what's the question I feel bound to ask? Well, how much is Iran hurting themselves by keeping Hormuz closed? Because even Chinese vessels aren't risking the journey at this time. The attacks have stepped up on infrastructure, and you will have heard in recent days Mr. Trump talking about bombing their energy infrastructure, but keeps putting that off and putting that off and putting that off. Just before I came on the live today, I see that ultimately he had said that they had another 10 days. They've got till April the 6th, I believe it is now. Feels a bit like another taco. Whether there's actually any progress being made in the Iranian talks, who knows? But you push him, you push him, you push him, and he will do it. I think we all know that. But you know, the new old regime kind of sees this as an existential threat, this whole thing. So any secondary concerns behind their survival as a regime are likely to be exactly that, secondary concerns, even around economic collapse. Apart from anything else, it'll just be a cost of doing business. I think they might see it as. But from an economic perspective, it costs an awful lot less to blockade or defend the strait than it does to police or guarantee the passage through it. But of course, the US seems to have infinite money in these situations, as is widely documented after the several $1 trillion that have been spent on wars in and around the region over the past 25 years or so. But the threat is also more about threat than it is 100% success. You don't need to sink every vessel. If you're in Iran's shoes, you just need to pretend that you might do, or give enough of a probability for people to believe that. Drones and mines are incredibly effective, and they do it for a lot less money. They won't be able to sanitize this coastline. It's not going to be possible. Do the US and Israel just escalate in terms of these infrastructure attacks and then push that towards a ceasefire? And I guess that would be the primary, the Secretary of War or whatever. Who would have thought if you rename a department Secretary of War, that would encourage you to go to war? I mean, how incredible, right? But will they be saying to the Iranians, well, look, either we can have this negotiation now before we do all this extra damage to the energy infrastructure, or do you want to stab the infrastructure, do the damage, and then we're going to have to talk about it? Incredibly high stakes stuff, of course. And Trump keeps going on about he's not getting what he wants from his NATO allies, and all that effort he's put into building those relationships. Who'd have thought he wouldn't get what he wanted? But he has hinted a few times now to winding down this military campaign. The other plan is that he's telling people steering oil tankers, I saw in a clip that I watched, that they need to grow a pair, basically. It's not going to go down as the most comprehensive military strategy of modern times, and it doesn't hold up very well compared to the quote from Winston Churchill as I kick this piece off. But there we go. I guess the no-brainer, apart from an observer with an opinion but no real expertise in this area, is that there was ever going to be a greater incentive to develop a nuclear weapon so that this sort of thing doesn't happen again. Surely this is it. And that's the perversity of the incentives. Public hangings of protesters have continued in order to keep a lid on any potential uprising. And of course, that mass slaughter that began in January has already kept a relative lid on that, so that this isn't genuine regime change or even hopeful regime change. And I think at the moment, the Americans know that there's just not enough groundswell, not enough people who are willing to sacrifice their lives in order to achieve that. So we're going to retreat once more into the safety of the UK real-time property market. And this is Chris Watkins' analysis and my take on it from week 10 of the UK property market in 2026. And Chris runs his week Sunday to Sunday, so this is week ending 15th of March, right? But we continue to pull ahead of 2025 in terms of listings, one more week ahead of 2025, 362,000 homes listed so far in 10 weeks. Obviously, that's 36.2k per week on average, 1.2% ahead of 2025, 12.8% ahead of the 10-year average. So 13% more stock on the market than usual, than would be typical at this point. And that's added to the market this year. Remember, we already started from a base of having quite a lot of stock on the market. So this glut of listings is absolutely persisting. What do we know? Well, we know that first-time buyers are especially active. They're doing more than half the business at the moment that there is in the market, a high for a decade-long high, which is great news for FTBs and good news for anyone selling a property, an ex-rental, because they tend to fit first-time buyer profiles pretty well. But remember, this mind-blowing stat of only 53% of what's going on the market is actually selling, which I can never get my head around, to be honest. I just find that incredible, but that's where it is, mostly because of over-instruction, Mr. Watkin would tell you, and I do agree with him. Agents telling people their properties are worth more than they are, and they just give up selling them because they thought they were going to get a better price than they actually end up getting offered or not getting offered in that case. But this is why rental supply is moving downwards but not crashing, in my opinion, because the 47% that don't sell, what do people then do with them? Well, ultimately, if they were ex-rental properties, they might rent them out. Even if they weren't ex-rentals and someone needed to sell it to move on, they might be in a position to be able to rent it, and then they might go and rent somewhere else, or they might rent it and buy somewhere else, which would add one more piece of stock to the rental market. And I think that's why rental stock is sort of ticking over. So with so many first-time buyers, are there fewer actual renters out there? Well, of course there are, naturally. But you've got to answer that with official data. It's a pretty reasonable hypothesis. It also depends on net migration, which there's an argument is very low or even zero at the moment. Although, again, that might have changed things with the situation in the Middle East, because certainly if you were set on going out to Dubai or whatever, you may or may not have changed your plans in the interim. Gross sales are at 246,000, sold subject to contract year to date, 8.4% higher than 2024, 3% lower than 2025. But that was 6% lower a couple of weeks back, because we've reached that time of year where last year people knew they weren't going to make the 31st of March stamp duty deadline. So that lack of urgency that deadline has created, it's a bit smoother than it was. And this is bound to wash out maybe by the end of April this year, maybe by the end of the first half of the year, it's fair to say. So April 2026 is going to look drastically superior to April 2025, even with the backdrop of what's going on with interest rates, geopolitical uncertainty and the likes. But I think everybody still feels safe in the UK. And that's a key conversation I've been having this week with people who are resident out in Dubai. Apart from anything else, it's that feeling and it's the perception of safety. It's not even the suggestion that Dubai isn't safe. Dubai are doing an incredible job by all accounts in terms of keeping people safe. But when people can see physical rockets and things like that are being reported, it completely changes a big part of the value proposition. Having spoken to a number of people who've moved over to Dubai, they love the safety over there. They love the extra policing, the lack of policing by consent like we do in the UK. They love all that sort of stuff. Everybody tends to until they get arrested, of course, I would say, but there we go. So what are we going to do? I think, what's the market going to do? That's the big question I keep getting asked at the moment. It's going to go sideways. You know, there's loads of supply. Prices are going to keep dropping in real terms after inflation. Inflation is going to go up. Prices go sideways, then it's continuing to adjust, and everybody's happy apart from those of us who benefit significantly from capital growth. We would prefer that was going to happen faster, of course, but a bit more inflation. I've always said we're the second biggest beneficiaries of inflation behind the UK government, property investors who use leverage, right? So it is what it is, but be careful what you wish for, as always. Net sales 8.6% ahead of 2024, 192,000, and 15% ahead of the 2017 to 19 market. So healthy stuff on the net sales front. And to start March, there was this 10 plus year record number of homes on the market for a March. And we still haven't quite ascended over the 2025 peaks, but we look very much set to blow through those this year. But 682,000 homes on the market at the 1st of March. Compare that to 675,000 in 2025, and you might say, what's all the fuss about? It's only 1% more than that. But we're still listing more and more and more. Let's see what happens. Sales pipelines are a few percent below where they were 12 months ago. That's fair, 3-4% lower than they were in 2025 at this sort of time of year. So not incredible, but material, I suppose I would say. And reductions, there were 22,900 in the week in question, back under 25,000 a week, but 11.4% of stock reduced in February. 2025 average 12.8%. Long-term average 10.75%, but that does include a very hot market like 21 and 22, where very little stock needed to be reduced before it sold, apart from anything else, right? And the fall-through rate stays nice and low, below 20%, 19.6. Longer-term average is closer to 25%. All still ridiculous. 1 in 5 falling through is a lot. 1 in 4 falling through is ridiculous, but that's the way the system in the UK works. And then Feb 26 saw sales agreed averaging £343.36 per foot. Much closer to the current ONS numbers, a 2.3% increase on the year. ONS said about 2.5, right? That's 18.2% ahead of 5 years ago. Feb 21 was really accelerating very fast if you track that back. And a huge slice of that 18.2 actually happened in 1 year. But we'll keep monitoring it. Exchange prices were well down on the month, £339.57 per foot, which is a big move down from £348 in January. But you do see those monthly anomalies that happen. I don't put too much store into 1 month's figures on anything realistically. We want an early warning system. That's why we look at these figures every week, but I don't think there's too much to draw immediately from all of those. So, Chris, you're going to get my weekly appreciation piece now. Thanks so much for what you do. If you ever want any help, anybody listening or watching, to them positioning as a local property market expert, if you're an estate agent, if you're any form of property professional, give Chris a shout. Go to his YouTube, youtube.com/@ChristopherWatkin. Give him a follow, give him a subscribe, give him some love, please. Okay, week 3 of March we're talking about, and macro-wise we had ONS unemployment figures, the labour market report, beating consensus actually for the first time in a long time, Rightmove's house price index, and then MHCLG data, Ministry of Housing, Communities, Local Government, on planning applications in England. And of course for afters, as always, we have the gilts and the swaps. And that slot really isn't going anywhere with what's going on at the moment. You know why we're watching it. So let's kick off with the labour market report for January. It was 6,000 extra people went onto payrolls between December and January. A small victory, but to be celebrated. February's estimate is for 20,000 extra people going on payrolls. And for the first time in many months, I remember this being a meaningful upward number. Now, it's just an estimate at this time, so let's see what happens. And then the employment rate, which is my favoured metric, also ticked up 0.1%. It stands 0.5% better than at the election of the Labour Party. I'm labouring this point, sorry, because no one else is saying it. Not because I think they've done a great job. They demonstrably haven't. Indeed, this has happened despite them rather than because of them, because luckily the economy in general keeps calm and carries on. Economic inactivity has also ticked down to 20.7%. So remember, this is the number that covers people who aren't seeking work right now, that's unemployed, and aren't employed in a job right now. It doesn't say how many hours a week they're working, but it does say that they're employed. This covers everybody else. So there might be in education, there might be in caring, they might be retired early, because this is covering everyone between the ages of 16 and 64. 20.7 might sound high to a lot of people, but for the UK, it's not a terrible number at all. It's on the way back down. The measurement in general is a good one. Yep. And what else do we know? Youth unemployment is looking really rough at the moment. Vacancies came down by 6,000 or so in the past quarter. So that almost suggests no new jobs being created, doesn't it? Because 6,000 people went on payrolls, vacancies went down by 6,000. Not quite as clean as that normally, but just shows you it might be a little bit static in that job market. But it's pretty flat stuff now after the shedding of vacancies after the post-COVID peak in vacancies, which was over 1 million. Employment was up 60,000 in the final quarter of 2025, 0.2%. Self-employment was down 28,000. Many small businesses would agree, right? And if you think about it, it makes sense. If the minimum wage keeps getting forced up so much and rates and another multitude of taxes go up more and more, the incentive to be self-employed simply erodes. Good for the country? Doubt it. Self-employment fell 0.7% in quarter 4 of 2025. Now, over the course of 2025, this stat really blew me away from this report. Employee jobs were down 25,000. A bad number, but when you're talking about over 30 million people in the workforce, I think it's over 36 million people in the workforce, not necessarily anywhere near as bad as you might have thought, a tiny fraction of that. Self-employed jobs, meanwhile, in 2025 were down by 242,000. So I'm stunned I haven't heard this or seen this framing anywhere else, right? But that tells a huge story, right? If I was in the manosphere, I'd be referencing the Matrix right now. I'd be doing that hand signal. There it is, right? You know, if you haven't seen that yet, by the way, that documentary, you've got to watch it. I very, very rarely watch it or listen to anything other than podcasts, economics news. I really genuinely am that sort of exciting person. But that was one voyage of discovery, that's for sure. And if you've got kids, have a chat with them about it, especially if you've got boys or young men in the house, right? Annual private sector wage growth rate, 3.3% compared to 5.9% for the public sector. We've still got this base effect thing that we keep getting told is going to phase out over the next few periods, however long that's going to take. But real pay growth above inflation is lagging around 0.5%. But at least it's positive at the moment. Now that's going to reverse pretty soon, I think, because if you look at the Iran situation, Wage rises ultimately have been done, and the people will bear that inflation depending on where it goes up to. Thoughts are around 3.5 or possibly a bit more. We'll find out as time goes on with all of this. But ultimately, even if everything stopped today, remember there's been permanent disruption here with all of this. And as we found out in 2020, 2021, etc., you don't mess with commodity supply chains and then switch things back on. It doesn't happen. Oil wells get filled up with water, etc., etc., etc. These things take months to fix infrastructure problems like this. Okay, so I think we're probably at zero real terms increase right now in terms of where wages are going. But zero is zero. You've still got that nominal inflation. You've still got the psychology of that. You are where you are, but of course you might have people forking out more money on energy. Not yet. 1st of April, remember, sees that go down, not upwards. So good news in many ways. Let's see what happens. And then we've got Rightmove's house price index. So this sees asking prices up 0.8% in March, typical for this time of year. Sun's out, guns out, it seems. Stock on the market, an 11-year high, Rightmove tells us. They describe the market as steady despite the global uncertainty, but in honesty, I'm just grateful that our biggest problems at the moment are fuel costs and energy problems compared to the hundreds of millions of people who are a lot worse off in a situation like this. But Rightmove's take is that we're only 2% behind the buoyant market of last year in terms of activity and 5% ahead of 2024. So a bit different from the Watkin figures there. They've got new listings 3% behind last year. Now, what does that show you? Because Chris Watkin data is cross-portal, right? It's from 20CI, so it looks everything. Well, what it tells you is Rightmove are losing market share, right? Because listings across all portals are up 1.2%, right? But they cite once more the clear north-south divide, as we've been banging on about for over a year now, I think, and then the opportunity for first-time buyers with a small annual fall in asking prices in the typical starter home sector. Now, why would that be? Well, as I said earlier on, if lots of rentals are being sold and this stock isn't coming from nowhere, it must be coming from landlords looking to dispose. It's the only thing that makes sense. There's a lot more of that stock, and even though there's more first-time buyers, there's more supply than there is demand, and though the asking prices are quite realistic. And ultimately these days, if you want to move a home on, apart from anything else, you want to move it on before you get to double council tax, before all the holding costs cripple what you're doing anyway. You lose your cash flow, you've still got to pay that mortgage out. You want to fix that situation as quickly as you can. And what Rightmove classifies as a typical first-time buyer home has an average asking price of 227k, down 0.4% on the year. Second steppers, they have an average asking price of 346k according to Rightmove. They're up 0.6 on the year, asking price-wise. Top of the ladder, absolutely flat, but those prices moved up 2.3% in March. Can't see that being that successful, but quite a few people with higher priced properties have waited and waited and waited and then gone on in spring, hoping to make the most of arguably the second or third biggest listing period of the year. After school holidays is a big one, trying to wrap things up before Christmas. And then ultimately Boxing Day itself / first weekend of January is the other one that looks big. But of course, houses look better in the spring, in the sun, normally speaking. As I look out the window right now, it's raining, but it has been sunny, so it's looked good. So Rightmove's resident property expert Colleen Babcock describes this year's spring market as steady rather than strong. I always think Colleen's pretty fair, and I think that's another fair comment. She also cites the longest average time to sell since 2013. So that's a 13-year stagnancy. And that is the symptom of just having so much stock on the market. Great advice from her as well, which I've quoted directly because it very much correlates with what we hear and what we conclude, what I conclude from Mr. Chris Watkin's efforts every week as well. In this kind of market, being not only competitive on price, but competitive from the outset when setting an asking price for your home is critical. Our research shows that relying on later price reductions is a much tougher and less effective strategy when buyers are very price sensitive and have so many alternatives to choose from. I would only add one thing to this, a point that was made to me by someone this week that resonated. When there's so much choice, blindness and prevarication are bound to rule. Give people too many options and they choose none. I always say this to people on proposing creative deals with vendors. Don't overcomplicate and ideally offer 2 options. Rarely do I offer 3. My price, your terms, your price, my terms. They watch the average 2-year mortgage rate closely, and this has soared in recent weeks, of course, up to 4.51 at the time of the Rightmove report from 4.24. Up a fair bit more now. I heard figures over 5% quoted this week. But ultimately, the 2-year bond is still at about 4.5%. It's come right back up to there. So that's, generally speaking, where things tend to be in the market. That's best price rather than average price. But how useful average price is, I don't know. The real figure is the drawn money figure that comes from the Bank of England Money and Credit Report on a monthly basis. That is the one that I like to look at rather than money facts or something like that. Taking the average rate, if you've got rates out there that no one's going to take because they're way out the money, what's the point of quoting them? And you certainly shouldn't weight them as an average. You should weight them where all the business is done, largely at the bigger retail banks, apart from anything else. Colleen puts in some very sensible context again, an extra 45 quid a month on a new house purchase by the time they produce their report, but still £70 lower than it would have been 12 months ago. That £70, I think, has pretty much been erased now. We're basically back to where we were 12 months ago, but we're back to where we were 12 months ago, specifically on 2-year mortgages. 5 years, a little bit more expensive than they were 12 months ago, but not a huge amount. We've just lost the progress that we'd made. But their mortgage expert, of course, he's kind of obligated to, isn't he, Matt Smith? Paper over the fact that market now thinks rates will be back over 4% by the end of 2026. 4.5% was the overnight index swap base rate expectation for New Year's Eve this year as I started recording this video. He does break the news we probably won't cut rates again in 2026. No, Mr. Smith, we probably won't. In fact, we won't. You know, even the Doves voted not to cut in March. Their first static vote for many a meeting, which I'll tell you a little bit more about later. And then the regional asking prices tell a story as well. London asking prices down 2.1 year on year. South East down 1.1. East down 0.2. Southwest down 1.8. Northwest up 2.6, with Northeast only up 0.6. The East Midlands and Wales are the next best behind the Northwest, up 1.3% year on year. A flat market with the North-South rebalancing, only about 100 years to go until that's sorted, still taking place in front of our eyes. But another good report from Rightmove, so it's useful stuff. So what about these stats from the planning applications from the ministry? Well, I'm not sure this is what would have been expected with all this liberalisation of planning and how much better things are getting, but clearly viability is still having a really serious drag effect. And that certainly isn't as advertised of that I'm sure, in terms of what the Labour government was saying when they got elected. Planning apps down 4% compared to quarter 4 2024. So that's even with a better outlook for the market. Lower interest rates when all this was coming through, remember, as well. Decisions also down 4% quarter on year. 20% of major applications were determined within 13 weeks. Remember, that's the statutory timeline, 20%. I mean, who's marking that homework, folks? It's just rubbish, isn't it? Now, in case you're wondering about the year, 300,600 planning apps were decided. Now, they're not all for building new units, but of course, one app might have more than one unit on it. So don't worry too much about the 300,000 number. That's down 5% from the year before. I'm, again, a bit surprised I haven't seen much coverage about this anywhere, because this is the best evidence so far that we've got that the 1.5 million homes is an utter pipe dream. And of course, we've known that. Of course, we've said it. Of course, we've listened to the sensible industry commentators who have said that as this time has gone on. But that's where we are. Applications on hand are down 2%. The graph is just horrible since 2021, to be fair, but the trend has not yet been arrested. The bottom is yet to come. The structural issues of supply and demand in the UK market are just to get worse unless the population is to start falling. Recent geopolitical events make that even more unlikely than it already was, in my view. But 9,600 decisions made in the quarter on residential development, 7,300 granted, 75% granted, 900 major decisions made, down 5%. Decisions are down on the year, 10%, and 6% fewer were granted. Build, baby, build. More like lie, baby, lie, isn't it, really, to be honest? It's all grim, it's all down. I can't find a single positive in this report to show any kind of progress on planning whatsoever. Has the trend downwards even slowed down? Not really, even in these figures, no. The best thing I can find to say is that it can't go much lower. Or can it? Now that's cheered you up. I know what's needed. We need to talk about the gilts and swaps. You might have seen the headlines as the 10-year, the flagship bond for the UK, rose towards the 5% yield mark last Friday for the first time since the financial crisis. So you probably know by now this is the third week in the row of the black armbands for those of us who borrow a lot of money. They didn't get there. They topped out at 4.97 and closed at 4.94. But they are clearly very close. And this whole scenario has reshaped the yield curve somewhat. The first 7 years of the curve are very flat indeed. The most dangerous shape for a yield curve often happens before a recession, apart from anything else. But we haven't been able to trust the signals out the yield curve over the last few years for a number of reasons. I think we're ready to pivot one way or another, realistically. But the market's best estimate of the base rate by the end of 2026, I have to emphasise this, between 4.35 and 4.5%. That's 2 to 3 rate hikes from here. That would be May, August and November, 0.25% each time, probably. But if things get much worse or more inflationary before the May meeting, a 0.5% rise would not be out of the question. And in that somewhat bizarre way, not moving the base rate upwards will not help the 5-year yields, which we watch week on week. The facts have changed, and we all need to change our minds. Okay, let's just join me in praying to the god of taco, because Trump does always chicken out, or at least we hope. He's referred to winding down a couple of times. He's the sort of person who does let his feelings slip when he talks. You keep him talking and he keeps giving you information, some of which he's probably been told not to say by his briefing people. But he's just so very confident, isn't he? And that's why he does that. So as and when they feel they've done enough damage to Iran's infrastructure, it would be on Iran to continue to retaliate or not. China must be putting pressure on to return to normal. They want their oil. They don't want Hormuz closed either. And of course, they lost Venezuela recently, which is a bonus for the US, I'm sure, in all of this. But ultimately, there's more to do than score points against the Chinese. So the 5-year gilt yield opened the week at 4.32. It touched 4.17 on the Wednesday morning, and then it just went up and up and up and closed the week at 4.588. Context, we're still 40 basis points off the mid-2023 high for this bond, 4.98. The last time it was this bad, August 2023. Thursday's close on the swap, 4.148% on the back of a close on a gilt of 4.459. So we're back to about 30 bips discount. But with this curve being so flat, I cannot see why the swaps are trading at a discount, apart from there being a supply and demand issue, because demand for 5-year swaps is going to fall ultimately if it affects the mortgage rate. But and if it affects buying appetite, it certainly does for investors, even if it doesn't, even if investors are only 9% of the borrowing market at the moment, it still changes things materially. Because as I said, take 14% of the world's oil supply out, price goes up 60%. It doesn't go up 14% because it's not a linear relationship, right? So what does all this mean? Well, for the last couple of weeks, I've been telling you to take the price. And right now, you really need to go back to pricing your debt at 6 to 6.25% for limited company property purchases. That puts a lot of deals in the bin from experience over the last 3 years. Now, unlike my thoughts in much of 2022 and 2023, this time around there is more logic to a 2-year fix at the same sort of price. It's basically a defensive move waiting for a better time. 2028 is also, in my view, if you're fixing 2 years today, a very good year to be considering a large refinance if you're holding a portfolio, because of the political uncertainty there will be in the United Kingdom in 2029. You don't want to be having to act too close to that election, in my opinion, because the bond markets could get really nervous if the polling is leaning in a certain direction. Either way, part of the attraction of reform, no track record to show they're just going to be the same as everybody else, overpromise, underdeliver, healthy amount of probable corruption, will not wash in the bond markets, I don't think. And as for Polanski, he's one that keeps bond traders up at night. So I've got some restructuring and refinancing penciled in for 2028, that's for sure. The 50-year bonds are above 5% yield for the first time that I can remember. It's certainly the highest close for over 20 years. So we're going back pre-financial crisis. They still weren't that high, 5.134% yield. I think they're probably a magnificent purchase, even if inflation in the shorter term makes that price look bad. I'd be stunned if you couldn't trade out at a significant profit at some point in the coming months and years. But we're not here to gamble, and I'm not a tipster, so that's just my view. The 30s opened at 5.475 for the week, closed at 5.57 on the yield, so another 10 basis points the wrong way, but a lot less harsh than the 5-year, 28 basis points lost. And that makes sense because this is a shorter term impact scenario, making the shorter term bonds a lot more sensitive, which is why the 2 years have moved even more than the 5s. Now, the UK yields have moved a lot more than a lot of their compadres in the Western world, more than the US ones, more than the German ones. Well, why? Well, because it hits us hardest because of the amount of percentage of stuff that we import. We're more sensitive to this inflation. We have to take the price. a lot more than other nations do. Yields had already moved against us because of the result of the Gorton and Denton by-election. And if one little by-election is enough to spook the bond markets, imagine what 2029 will be like. You see my point. I seek to empower us all by getting us to plan what tactics will be. That's those who followed what I was doing in 2022, fixing for 5 years. Obviously, if you do the maths, those things roll off in 2027, don't they? Will we fix for 5 again then, or perhaps even longer? This cycle might actually work reasonably well in our favour if the bond markets have settled down by next year. But if the Greens have a surge in the May elections, and let's face it, they will gain council seats, Labour will lose them, Conservatives will lose them, and Reform will gain. It's only about how much that all happens. And depending on what happens there, yields could wobble further just on the back of that in early May. Not ideal at the moment, I know. So what I'm saying to you is this feels to me like a time to be defensive. But it might just be time to take a breath and wait for a few weeks if you're refinancing something, as long as you're in a position to still be okay if things go the wrong way. Why? Well, back to those 2022 trust time comparisons. The market is panicking a bit at the moment. We're in nowhere near as bad shape as 2022 just yet. We didn't start from such a good base as we theoretically did in 2022, but we're still nowhere near in as bad shape. The difference is that 2022 was self-inflicted, but at this point we have very little control, and let's face it, very little influence, although we do have more if we stick with France and Germany. Trump's got midterms to navigate, and his base would promise lower fuel prices. I saw the other day they had about an 85% chance of retaining control of the houses some months ago. I was surprised it was that high, to be honest, but apparently that's what the polls were saying. That was now 50-50 a few days ago. Sunk pretty quickly, and the worse it gets, the more that will happen. Ultimately, promises voter base lower fuel prices, about half the gains from where he'd cut things to after Biden had been in charge and presided over what happened in Ukraine in 2022. About half those gains have been given back, and it's not going the right way for them at the moment. The US perspective, really, I think, is this war has not got a lot of time in it. That's the gamble that they're taking. So more escalation and then a further bizarre declaration of victory. You know, I know he's sick of winning, and they're winning so much, and he's already won this one at least twice, I think. Could be 10 times by now. That cuts through and calms prices down. He knows what to say in order to calm the markets down to an extent, but there's ultimately only so many cracks you can paper over. Every day it goes on. In the early phases, though, one day does not add one more day to the end of the war. It adds days or weeks to the end of the war, right? To a probable ending. It's either done really fast or it drags on. There's just not much in the middle ground when you look at historical precedents. The 12-day war of last year, right? Or Ukraine, February 2022, still going on. So maybe there is some calm coming, but now isn't the time to do marginal deals, folks. Anything marginal needs renegotiating if it's in your pipeline. So that sets up the deep dive, and there'll be no surprise to know that first up, we look at the Bank of England meeting from this week. Then there's a research piece that I commissioned. I say commissioned, that's what you do these days on Gemini or your AI of choice, of course, on the MFS bridging fraud situation and the up-to-date thoughts on what might come out of all of that and what risks there are to private credit and shadow banking sectors. We also look at the Bank of England agent summary of business conditions. These come from the horse's mouth, from local business leaders via their regional reps, and they're valuable. And then I thought we'd better strap the masks on extra tight and look at Generation Rent's latest report on energy efficiency in the private rental sector. Hold on tighter than usual, folks. Okay, the Bank of England meeting minutes and summary. Now remember, this one wasn't a full updated report meeting. Those happen in February, May, August and November every year. So here's the report with my take on it as well. So theme number one's got to be the freeze, pausing at the crossroads, base rate fees, unanimous vote to hold at 3.75, 9-0. Little bit of a surprise to the consensus. Why? It's obvious why. It's Iran. It's the global supply shock that this is creating and a reassessing of the medium-term outlook. If you give a central banker a reason to wait and see, oh, they will do it, because that's what they do, right? But all members stand ready to act as necessary to ensure inflation returns to the target. A reminder of the single mandate side of things, which I've talked about a bit over the past couple of weeks. But I've been saying for months and years that the disinflationary glide path would never be a straight line. Here we are. So there's eminent sense in what they've done this week. They did the right thing at the time. The biggie is Dingra and Taylor, the two doves who voted down at every meeting I can ever remember, voted to hold. The economic consensus was they would still vote down because they would put the want and the need to cut the rates over and above the geopolitical uncertainty. That did not happen, and they said, no, listen, let's hold. They might be on the bus for a rise if a rise is what needs to happen to control inflation, because what you don't want to do, especially when you haven't got it back under control yet and it's still been bumping around 3%, and I've said this a number of times over recent years, ultimately, if you've got a situation that you start from that is already above your target and not out of control, but outside of the range of comfort, then a little change to the upside makes a much bigger difference. It's so much easier to go from 4% to 5% when it comes to inflation than it is to go from 2% to 3%. Now, we're already at 3, much easier to get to 4 than it was 2 to 3, or get down to 2, which of course we were told was going to happen in April. Bank of England forecasts in absolute tatters on that front, of course. So there's no idiots on the Monetary Policy Committee. There are some people, or at least one, who isn't a brilliant economist, but that's more at the top of the tree side of things rather than the externals. And if he's a good leader, he can perhaps get away with not being a very good economist, you tell me. But they said wait and see, which is what we expected. It's an emphatic hold. The bond markets didn't really like it. They'd have preferred a preemptive hike. Now, there's an argument for that, but bond traders move in seconds or fractions of a second, and central bankers move in weeks and months. So the hold in the context was the right thing to do. They need to exude calm. That's what happened after the Brexit referendum. Mark Carney exuded calm to the markets, and it did the markets a favour at the time. So, theme 2 is the energy shock and inflation's unwelcome return. So we know about Hormuz, we know about oil going over to 100 a barrel, we know about 60% increase since the February report, that's what they're comparing to, and they had a 60% wholesale gas spike according to where they were in their February report. Bank of England CPI inflation at the point of the meeting, they were suggesting it'd be more like 3.5% in March and potentially remain around that level in the third quarter, into the third quarter of 2026. So a fairly big reversal. They were talking about 2.2 or so by the end of the year. They're now saying 3.5. Now, of course, they don't know what's going to happen in Iran. They don't know how long this will go on, but they do know there'll be lasting consequences. That could be too low a forecast, depending on what plays out. But my take on all of that, well, I just think, just as you thought you could safely look at your utility bill again, here's geopolitics to ruin all of that. It's a huge headache for everyone, but particularly for the UK because of our reliance on imports, as I've talked about. And the bank's expectation that CPI will bounce back up to 3.5 is still grim reading. What does it mean for property? Well, operating costs for big portfolios, block management, commercial spaces, they're going to sting ultimately. But the real danger is the second round effects the MPC is sweating over. If inflation expectations de-anchor again, just as they were looking like they might drop anchor, wage demands will spiral again for 2027. Real estate has traditionally been an inflation hedge, but if you have the pricing power to push rents up. Given the current squeeze on tenant affordability, relying on endless rent hikes to cover your soaring operational costs is a fool's errand. Theme number 3, the mortgage market and tightening financial conditions. Well, what's our summary? The geopolitical shock has led to increased volatility and a deterioration in risk sentiment across financial markets. While it's too early for the committee to assess the full impact on bank lending conditions, term overnight indexed swap rates have already increased to levels previously seen in early 2025. As a direct consequence of these shifts in the wholesale money markets, some mortgage lenders have already increased the interest rates quoted on new mortgage products. Despite the bank rate remaining on hold at 3.75, the overall tightening of financial conditions reflects the market recalibrating the balance of risks to the path for the bank rate. My take on all of that, well, this is the harsh reality on how capital markets actually work. You don't need a base rate hike to see your mortgage costs jump. Yes, base was held at 3.75, but the damage has been done in the swap markets already. The overnight index swaps going back to early 25, that's the real story here. We're now a little bit above early 25, or about where we were in the January wobble of 2025, if you remember it, when the phrase bond vigilantes was last wheeled out once again. Lenders are not charities. The second their hedging costs rise, they pass the pain directly on to borrowers. We're already seeing lenders pull their most competitive products and reprice upwards. I had to take some 6.14 earlier this week. It's still not a terrible price the way the bond yields stand at the moment. And of course, what I will do is I'll make sure I keep checking in on that before the loan completes. And if things have moved downwards, I will be able to move that rate down. If they don't move downwards, I'll be able to stick with that rate and ultimately probably possibly be happy that I've taken that price. Not nice for your average buy to let, let's face it, because you need some pretty strong yield to be able to afford 6.14 or very low OPEX or both. And then so theme 4, stagnant growth, the real economy squeeze. Well, look, we've got a bit of spare capacity in the economy. We've kind of known that for a little while. Many ways to measure that, but one of them could be the average full-time employee would like to work about an hour and a half more each week. They'd like that extra money. That isn't, the demand for that isn't there from the businesses at the moment, right? That's one of the ways we measure excess capacity. UK GDP up 0.1 for fourth quarter 2025. Activity remaining subdued in the first quarter of 26, which we know. Monthly GDP flat in January, which we talked about. And the MPC notes that ultimately household fuel and utility costs going up will squeeze those real incomes. That can cause deterioration in consumer confidence from not a very good level in the first place, of course, mostly thanks to the government. Precautionary saving to rise and potentially a more rapid or larger rise in unemployment. It also lowers consumption, so it lowers growth. It increases the probability of business failure. It really is not good stuff, folks. I can't tell you enough. So get rid of the jargon, right? The real economy's flatlining. GDP 0.1 is a rounding error, realistically. Labour demand is weak, but they're terrified of wage inflation, the bank. They've been trying to control this for years. It's just a big fat contradiction, really. We're looking down the barrel of stagflation. First used that treacle analogy back in 2023 to describe our economy, and we've just had a wholesale delivery of golden syrup here, basically. For the property sector, a squeeze on real incomes is the ultimate headwind. Tenants will be hammered by utility bills being higher. That limits their capacity to absorb rent increases, and if unemployment also ticks up further, as the MPC now fears that it might do, too little too late, arrears will become the #1 issue for landlords. Capital growth is off the table in a stagnant economy. The sole focus right now needs to be on yield, cash flow preservation, and retaining high quality tenants who can weather this macroeconomic storm. Not great news, I know, but the supplement delivers the truth, not paracetamol when you've got a headache. So next up, the MFS situation, as per my deep research prompts via Gemini, which I've summarised here for everybody. So, theme 1 is the mechanics of this MFS-backed black hole. So Market Financial Solutions, as they were known, Mayfair-based bridging lender, formally entered administration last month. The shortfall is catastrophic, between 1.3 and 1.7 billion. So only 19.8% of a specific 1.16 billion collateral tranche actually held true unencumbered value. At the core of this collapse are allegations of systematic double pledging, and actually up to 6 times from what I heard in what I was told over the past few weeks. There weren't perfect legal charges at the land registry. It wasn't done in a traditional way that you or I might be used to. If we take a loan out from somewhere, they were securitising these loans in the background using spreadsheets and securitising the same property multiple times effectively. Fraudulent, as has been said. And I've warned about the opacity of these structures over recent years. The sheer arrogance of the institutional capital here is staggering. You've got elite Wall Street risk committees writing 9-figure checks based on equitable assignments, entirely skipping the fundamental legal perfection at the land registry to save a few quid on administrative friction. They prioritise deal velocity over basic due diligence, effectively treating an unregulated originator's spreadsheet as an unquestionable piece of gospel. It's a classic case of chasing yield in a 5% interest rate environment while entirely forgetting the underlying mathematics of risk. The idea that an FCA registration for money laundering equated to a seal of operational approval is just laughable. It's not just a fraud story, it's a profound embarrassment for private credit, proving that without active on-the-ground verification, your collateral is just a polite fiction. So what about contagion towards private credit and institutional exposure? Well, severe contagion has been triggered. Court filings have meant 500 to 600 million in losses for Barclays. I saw 630 mentioned somewhere, and 400 to 500 million for Apollo. Significant material exposures for Jefferies and also SMBC. So this is compounded by the January 2026 collapse of Century Capital, another London bridging lender, which left the US asset manager Blue Owl Capital with a £36 million exposure to subordinated debt. And furthermore, in the exact same month that Barclays froze MFS accounts due to transaction anomalies, Citigroup controversially approved a £100 million credit facility for Interbridge Mortgages, a firm where the MFS founder, Paresh Raja, retains a 40% stake. These cascading events have exposed the liquidity mirage inherent within heavily leveraged private credit structures. The Propenomix perspective, well, the great private credit reckoning has arrived. We've known about it for a long time, and it's a bloody mess, right? MFS and Century Capital implosions are the ultimate cockroach events. If you see one, there's probably dozens more hiding in the warehouse facilities. Mega funds have spent the last 5 years blindly acquiring legacy assets through aggressive M&A, unwittingly importing toxic, poorly underwritten loans deep into their balance sheets. The Citi Interbridge anomaly is particularly galling. It's a catastrophic failure of cross-institutional due diligence, where the left hand is freezing accounts while the right hand is authorising £100 million facilities to connected entities. When the geopolitical shocks hit and the illusion of liquidity vanishes, these highly leveraged houses of cards simply evaporate. The contagion is real and the capital destruction is entirely self-inflicted. What about the prime central London liquidation shock? Well, to recover the monumental creditor shortfall, administrators from FRP Advisory are preparing to forcibly liquidate over 250 property companies directly linked to the MFS loan book. Densely concentrated in high-value PCL, prime central London, including Mayfair, Belgravia and Knightsbridge. The sudden influx of luxury supply is colliding with a sharply contracting PCL market. Average prices in prime central London have already fallen by 4.9% in the year to February 26. Market sentiment has been severely dampened by the threat of wealth taxes and the abolition of the non-domicile tax regime. So the historical London premium has transitioned into a London penalty, with transaction activity for properties above 5 million remaining a third below where it was before the pandemic. So we might see the greatest forced fire sale in modern London history. This timing could not be worse for the sellers, but it's an absolute gift for the true institutional allocator. PCL is paralysed at the moment by political noise and a punitive fiscal environment that has sent the ultra-wealthy fleeing to jurisdictions like Dubai. Although I have it on good authority and it won't surprise you, that's not exactly the destination of choice at the moment, and it has its own woes with losses of 30% or more in the local property market. Remember, 70% of their market is primary new build. That's I only found out this week. A friend of mine who lives there informed me that the occupancy-wise at the hotel that he lives in was 3% in the previous week. That is 3. So it's COVID Mark II. It's an absolute ghost town. You can't dump 250 stucco-fronted mansions and luxury riverside apartments onto a market where buyer demand is just evaporated without causing a brutal downward price correction. There'll be some fantastic deals out there for people who do want to hold BCL and still believe ultimately in London, as I think everybody probably should. Am I going to allocate a lot of capital in there? No, because ultimately, cash flow-wise, it just doesn't work around there. So it's not for my model, but those sitting on massive balance sheets, huge piles of cash and have the ability to borrow at particularly low rates still might well still consider how much more PCL stock they want to buy, if that's what they want to do. So this is the magic and the mirage of the zero interest rate policy is over. It is dead. But unleveraged professional capital sitting on dry powder, this is a generational acquisition opportunity. If you can buy at the true clearing price, not the inflated MFS loan book fantasy valuations, the yields will finally start to make mathematical sense. Okay, great. Back to the bank, but this time the agent's summary of business conditions. The macro landscape, a lacklustre economy and squeezed consumers. The Bank of England's latest intelligence, this is where the agents talk to regional businesses, the regional agents talk to people and get the real sense of what's going on the ground. Consumer demand for goods remains subdued. That won't surprise anybody. Cost of living is still a key theme that businesses are hearing, and the official inflation rate is not reflecting their lived experience, is how people feel. Food costs remain a massive concern as well, and younger adults and students are reportedly increasingly relying on overdrafts, credit cards, or buy now, pay later in order to make ends meet. So the headline figures tell us the underlying consumer price inflation was expected to ease before this report came out, but the reality on the ground, the official data said that it's falling, it's looking backwards. In reality on the street, it's rising much more quickly. Prices have not been dropping anyway. They've just been going up less than they had been before. Remember that one. When charities report debt issues have shifted from consumer credit to essential living costs like rent arrears and council tax, the consumer base sounds fundamentally exhausted to me. It's a rental market sustained only by inflation, not by actual volume growth or increased prosperity. You're never going to build a robust economic recovery, let alone a booming housing market, on the back of households maxing out credit cards to buy groceries. But this report was only put together with data up to mid-February, remember, so this was stagnant before the huge geopolitical shift. We started from a fragile base, folks, apart from anything else. What about construction stagnation and delayed recovery? Well, construction contracts have become more downbeat. Ultimately, expectations of recovery pushed out to early 2027, they say, and contacts ultimately expecting any recovery in construction-linked manufacturing will be delayed until late 26, early 27. Again, pre-Iran, this stuff. And this is what I've been warning about when we talked about structural undersupply in the UK property market. Planning, they said. Sure thing. But yeah, viability, as people have been saying, supply of contractors, supply of materials, all these things are problematic. Developers pausing new schemes. Developers I've been on the phone to saying, I'm not doing this scheme that I was doing. I just don't have the confidence in it at the moment. The end market is just not there, folks. That's what's been going on. So what happens? They cut starts, the WIP builds up, the pipelines build up. The PLCs and the big guys, they can afford to take some extra time. It hurts their returns. The shareholders don't like it. They drop in value ultimately, but they're not going to go broke on the back of it. The SME developers, different matter altogether. Okay, so what about the third theme in this report, the polarized property market? Well, you know, subdued markets overall, but with some big regional divergences, as I've been talking about for a long time. London and the south, downwards. North, Midlands, pretty much okay, doing okay. Scotland, pretty good stuff. Firm activity, modest price growth. But in resi, prices and margins do remain tight. Rental inflation has moderated, as we know, especially over the last year. Numbers of landlords are shrinking. That's pushing some more renters being first-time buyers. But the number of rental units is not shrinking as quickly as the number of landlords is shrinking. Commercial real estate is also equally polarised. Strong occupier demand, for tenancies, and then ultimately rising rents for prime, environmentally sustainable assets in central locations. But secondary assets face rising vacancies and falling rents. What's the Propenomix perspective? Well, the regional divide is starker than ever. Northern regions and Scotland are showing a modest price growth while London stalls out. Makes perfect sense when you look at affordability and where investment yields still actually work. Does the 250 property companies in prime central London, does that impact that ultimately? Not really. It doesn't even trickle down into that market. It operates like a completely different world apart from anything else. But you would think some of these assets might get snapped up, wouldn't you? Because ultimately, if you were going to move to Dubai and then you reconsider London, tax might put you off and you might just go to another tax jurisdiction. It just depends why you were going to Dubai, doesn't it? Because if the safety thing was a big factor, then that will be reassessed apart from anything else. So the irony is, although you're pushing some renters into buying, the remaining tenant pool are going to fight for a diminishing supply of homes. And that keeps the rental market tight. And that's what we've been seeing going on. There's a rapid flight to quality in commercial real estate. So ultimately, if you've got secondary stock, you're looking down a barrel of falling rents and empty buildings, especially if it's office, folks. The environmental premium is real. The obsolescence risk for older assets has definitely been accelerating. So what about the employment squeeze and corporate margins? Well, ultimately, employment intentions still remain relatively negative or slightly negative in this particular survey. They think wage settlements will average 3.6 in 2026. That's lower than the 4% average that was reported in 2025. But businesses are still reporting squeezed profit margins. They've got the subdued demand is giving them limited ability to pass on higher costs into their pricing. And to cope with these pressures, organisations are increasingly turning to automation and artificial intelligence, which allows them to meet demand without additional hiring. For some large professional services firms, this is contributing to reduced demand for early career recruitment. Now, my take on this, we're seeing a massive structural shift in the UK labour market. As I've said, from self-employed to employed is one of them, apart from anything else, right? Businesses cannot pass their rising costs on to exhausted consumers. They've got crushed profit margins. The only logical response is then to slash overheads. So employment intentions drift to the negative once again. I'm fascinated by the rapid adoption of automation to plug the productivity gap. And, from all the reports we're hearing of those early days in terms of the measurements, productivity has increased really quite substantially since AI has started to be plugged into businesses. But if your top line revenue is flat, then any increase in your cost base is going to be painful. So it's a difficult environment for commercial property demand. If companies are not hiring graduates and are reducing their headcount through natural attrition, they simply do not need more desk space. It all points back to a defensive, cautious market where survival and operational efficiency are the only games in town. The last up, Generation Rent's report on raising standards, not rents. Remember, folks, information is power, and keep your friends close. Theme one from this report, fuel poverty and the EPC gap. So what do they say? Well, guess what? Private renters live in the worst quality and least energy efficient homes, according to them. Now, energy efficiency wise, I could believe that, but we'll get on to my take on this a bit later on. This is from the 2024-25 English Housing Survey, which is seen as the Bible in these quarters. 51% of private rental homes meet EPC C or above, 37% in band D, 9% in band E. So poor energy efficiency ratings having a major impact on households' energy bills. Analysis shows a household living in a band E home will spend nearly £500 a year more on energy than a household in an EPC C home. So it's a significant difference, right? 21.5% of private renters in England are currently experiencing fuel poverty, say the official figures. 42% of private renters in England and Wales regularly struggle to pay their energy bills. Let's put on a bit of cold Propenomix perspective reality here, folks. Generation Rent are entirely correct that heating old British housing stock is a miserable and expensive affair. But this narrative that landlords are simply hoarding cash while tenants freeze misses the macroeconomic picture entirely. We're dealing with chronic supply constraints across the entire housing market, and when demand aggressively outstrips supply, tenants lose their ability to vote with their feet and avoid poorly insulated stock. The premium for energy efficiency is real, but retrofitting Victorian terraces is exceptionally difficult. If we actually built enough homes to satisfy demand, then the older inefficient properties would naturally face a discount in this market or be forced into modernisation. But instead, we have a system where any roof is better than no roof, which is a direct consequence of decades of structural underbuilding, not just landlord apathy. What next? The £10,000 cost cap and the exemptions. Obviously, this has been lauded as a bit of a victory by the NRLA and in the private sector, whereas Generation Rent are probably not going to see it like that, are they? So the government's stated ambition is that all private rented homes meet EPC-C by 2030, and in the consultation last year, they initially proposed £15,000 cap on spending. That was cut by a third to £10,000, and there can be a 10-year exemption, right? So it doesn't mean you never need to spend any money again, folks, remember. It's a 10-year exemption. So think about how that will actually also change people's thoughts and drive their decision-making around this sort of stuff, right? For homes worth less than 100 grand, if you don't already know, the cost cap will be 10% of the property's value. So these exemptions will add up. We're leaving around 707,000 homes without upgrades, according to Gen Rent. Currently, 578,000 households will remain stuck in fuel poverty. So my perspective here, well, I feel the outrage over the £10,000 cap is rather amusing. From an investment strategy perspective, the government's retreat from 15 was an absolute necessity. If you're holding a £70,000 terraced house in the northeast, demanding 15 grand of capex is just financial suicide. It completely wipes out the yield for years, if not decades, right? Well, with gilt yields hovering where they are and alternative risk-free returns readily available, forcing that level of unrecoverable expenditure would trigger a mass sell-off. The 10% value cap makes complete economic sense or is still too high. Generation Rent bemoans the 707,000 homes left without upgrades, but if those landlords exit the market, those tenants are not magically buying the properties, joining the queue for an ever-shrinking pool of rental stock. Capital is going to go where it's best treated, and a £15,000 forced expenditure was a remarkably quick way to chase it away. Theme number 3 is rent hikes, evictions and proposed controls. Landlord lobbyists have claimed they will have no choice but to hike rents after retrofit work. The report counters this by noting just 41% of landlords declare mortgage interest payments on their tax returns, indicating around 58% have no borrowing on the homes that they own. So analysis of first-tier tribunal decisions shows average rent discounts of £211 per month for EPC-D homes, rising to £673 per month for EPC-E homes. That all seems very false, doesn't it? And there's reasons that could be behind that, in that the A's and the B's are just much more expensive, newer build properties, or bigger and better insulated, better finished, and all the rest of it. That's huge, huge rent discounts, ultimately. Far more than the £500 a year extra power that they're spending. But like I said, I worry about that being a bit of a false flag. But to protect the tenants, the report recommends limiting rent increases of course it does, to the lower of consumer price inflation or wage growth. So this is this sort of rent stabilisation measure. It also suggests introducing a protected period from evictions, landlord need evictions, for 2 years after a government grant or loan is used to fund retrofit work. And you can see the logic in that, in fairness. If you use the tenant to get some retrofit works done and then get rid of them 3 months later, it doesn't seem to be a good faith transaction, does it, realistically? But in reality, I think if that's your mindset, you just don't do that anyway, because in the real world, it does not add anywhere near that sort of value to the property of the house. It might be a 10 grand's worth of grant spend that might add 500 quid to the house's value, because you're still not seeing anything like huge disparities between the value of a C, a D, and an E, and an A, and a B. There is some percentage, there might be 4% between an A and an E. That's the drastic end. And like I said, I am concerned that the A's are newer and blah, blah, blah. It's not just, what you don't have is you don't have a row of houses which go A, B, C, D, E, F, G in terms of energy efficiency time and time again, and then the ability to look at the data on those, because the location is the same, the only difference. And it's very difficult to control these samples for simple energy differences, so bear that in mind. What's the rest of my take on this? Well, this is where the report has gone from highlighting genuine problems into absolute economic fantasy. Capping rent increases at the lower of CPI or wage growth is just backdoor rent control. We all know how that ends. Catastrophic collapses in supply. This is what the Labour Housing Group wanted, rent stabilisation, and this iteration of the Labour Party are not interested in it. Angela Rayner? Maybe she is more interested in it. Let's see. As soon as she announces the words rent control, let's see what happens to the rental market. But the assertion that because 58% of landlords have no mortgage borrowing, they can just absorb 10 grand in capex without adjusting the rent defies basic yield mechanics. Whether an asset is leveraged or unencumbered, investors expect a return on their capital deployed. If you force an upgrade and cap the income, the maths fails. Look at the SONIA swap rates. Money is not free. If landlords cannot realise a return on their retrofit investment, they're going to use the exemptions, they're going to sell the asset, or they're just going to exit the sector, right? You can't mandate private capital into make losses and expect it to stick around. It will not happen. At the moment, they'll just buy a 30-year or 50-year bond, directly or indirectly. Who can blame them at 5%, 5.5%? No hassle, no abuse, no all the rest of it. No ambulance chasers and all the rest of it. But as we get towards the end for this week, our Manchester Property Business Workshop is continuing to sell very well. This workshop's in huge demand as we talk about exits. We cover tax, risk, deal structuring and exit options, not just for you, but for those who you will inevitably be dealing with to buy assets, portfolios, companies and the likes from. Can you help with their exit? I have over the years, often because they often have no real formal plan of their own. And I've added massive value, which has helped me to get deals over the line. Have you got children? Are you planning to leave a legacy? What does your plan look like? Do the kids know about it? They often don't. And spoiler alert, they often don't want to play ball either. So as always, we use some real life case studies about our own experiences and close with our no holds barred Q&A. If you've got anything individual to consider, then get yourself a VIP ticket and join us for the dinner. It's a smaller setting, an opportunity to discuss any specific roadblocks or issues in your property business at the moment. The VIP dinner in January was absolutely incredible. We got some fabulous feedback, and that upgrade to the ticket is well worth it, folks. Early bird pricing is still available with a 10% discount. Book those tickets for Wednesday, the 22nd of April, Central Manchester, tinyurl.com/PBWTEN. But whatever you do, even if you don't come to the workshop, please make sure you try and keep calm, always listen to the supplement, and carry on. There's going to be opportunities abound this year towards 2030 and beyond, and the landscape's set for a surefire bull run. Capital growth is going to remain slowish at the moment, although if you're in the right part of the UK, you need to be you'll be well looked after by the combination of that plus inflation, right? This big bull run is going to need some runway first, folks, especially with what's gone on, right? But let's finish off a brilliant golden quarter together. It's a case of here we go, in my opinion. And before I finish, I just want to give a shout out to my friends Jess McCauley and John Cox, who run the Phoenix Property Meet down in London at the amazing Dickens Inn, the former site of Partners in Property London that we ran there for many years. Props to Piotr Rusinek for finding us that venue in the first place, the amazing Dickens Inn at St Catherine Docks. I was there yesterday, where apart from anything else, who would have thought it, I was persuaded quite literally to take the shirt off my back Not this one, but one of my other very nice geeky formulaic shirts that seemingly only I ever seem to buy or wear apart from anything else. And I'm really proud to say it achieved £170 in the charity auction. So big props to Ross Harper for buying it apart from anything else. And those who bid it up, they did really well. And the shirts made a number of appearances. So if you see black shirt with squiggly formulae on online, you'll know it was one of mine. And that was a brilliant day out. They raised nearly £20,000 for charity. So John, Jess, really, really proud of you. Delighted to have played a teeny tiny part in all of that with my talk and everything else. Hope everybody enjoyed. Like I said, folks, keep calm, carry on, and see you next week.